The May 2025 downgrade from Moody's entered the history books. For the very first time, every major credit agency, Moody's, Fitch Ratings, and S&P Global, has officially lowered the United States beneath the top credit tier. At the same time, retirement accounts inside 401k plans have climbed to $10.1 trillion. The federal government also paid $970 billion in interest expenses during 2025. That equals 19% of all federal income, and those interest costs are expected to rise another 76% across the next 10 years. I have looked through enough information, so here is the complete breakdown. The smoke detector did not create the blaze. I want to make that absolutely clear immediately because many people are going to misunderstand this entire situation. The fire has already been smoldering behind the walls for more than a decade. Moody's was simply the final holdout. The final major ratings agency still maintaining the highest possible grade finally stepped into the room on May 16, 2025, took a breath, and basically said, "Yeah, we smell smoke too." Now all three agencies have stripped America of the highest rating available. That has never happened before in the modern era of U.S. finance. And buried deep in the notes attached to that announcement, not the headlines, the notes, is a detail that changes the math inside your 401k in ways traditional retirement guidance rarely explains. Here is what this video will actually discuss. And I want to say this clearly now because the topic is much more precise than the title probably suggests. This is not about whether the United States defaults on its debt. It will not. At least not in the traditional sense people imagine. This is about something much slower, much quieter, and mathematically far more costly. There is a mechanism built directly into the standard 401k structure most Americans currently use. A mechanism quietly moving money from your retirement account toward the creditors financing federal debt. And the downgrade is the warning signal that this process is speeding up. If retirement is less than 15 years away for you, the process is already active. Here is the image I want you carrying through this entire discussion. The Moody's downgrade acts like a smoke detector. It did not ignite the fire already existed inside the structure. But once the alarm starts ringing, the next phase begins. Because once the neighborhood hears the alarm, everyone starts talking. And once neighbors begin discussing the fire inside your walls, borrowing a ladder from them suddenly becomes more expensive. Let me introduce you to Gary. Gary is a 66-year-old living in Columbus, Ohio. He owned a hardware business for 3 decades, sold it during 2019, and had basically coasted on a 401k account he had barely touched since his 30s. Roughly $450,000 parked inside a target date 2020 fund. Safe, plain, conservative, exactly the type of portfolio a financial advisor would describe as age-appropriate. Back in August 2011, when S&P Global downgraded the United States for the first time ever, Gary's brother-in-law called and told him to liquidate everything immediately. Gary considered it, but he stayed invested. The market recovered within about 6 months. Gary felt smart afterward. But here is what Gary completely missed, and honestly, this is the entire point of the story. Every year automatically, while Gary focused on inventory reports and vendor negotiations, his target date fund kept increasing bond exposure while reducing stock exposure. The algorithm already had a roadmap. Gary never understood the roadmap itself. By the time Fitch Ratings downgraded the United States during August 2023, Gary had reached 64. His portfolio was sitting near 45% bonds. He was entering the most bond-heavy phase of his investing life at the exact same moment the federal government was signaling plans for endless borrowing at higher interest rates. Now Moody's has joined the same discussion. Gary is 66. He believes his portfolio is conservative and protected. Gary is exactly the kind of investor this story is searching for. In a few moments, I am going to walk through the exact figures tied to Gary's portfolio. And the conclusion will probably be more detailed than anything you have previously heard about this issue. But first, let me answer the obvious objection probably forming in your mind already. The stock market barely reacted after Moody's downgraded the US, so how can any of this matter if the market barely moved? The short-term market response to a downgrade measures only one thing: It measures how much of the information was already anticipated. By the time Moody's made its move during May 2025, institutional bond traders had already spent years reading Congressional Budget Office forecasts. They already knew federal debt had climbed beyond $36 trillion. They already understood annual interest expenses had passed $970 billion, nearly $1 trillion during the fiscal year. Investors had quietly demanded higher yields for roughly 18 months before the official announcement arrived. The market shrugged because the downgrade itself was already expected. Not because the downgrade was meaningless, the market had already begun charging America higher borrowing costs slowly and steadily before the headlines ever appeared. This is the fire inside the walls. The alarm simply confirmed what the walls already knew. Now, here is the statistic that completely changes the framework of this conversation, and I want you to really pause on it for a second. During 2020, the federal government paid approximately $345 billion in interest expenses tied to national debt. By fiscal year 2025, that number exploded to $970 billion. That represents a 181% increase across just 5 years. According to data from the American Action Forum, alongside confirmation from Treasury Department records during September 2025, that $970 billion equals 19% of all federal revenue. 1 out of every 5 tax dollars collected now goes directly toward interest expenses. Not highways, not defense, not Medicare, purely interest, and this is where the story begins feeling very different from previous downgrade discussions. During 2025, national debt interest payments exceeded military spending. For the first time in modern American history, the federal government spends more paying interest on debt than funding national defense. Nearly 1/4 of those interest payments eventually flow overseas, including toward China. Quietly and indirectly, taxpayers are helping finance foreign economies. And projections from the Congressional Budget Office estimate that number climbs from roughly $1 trillion toward $1.8 trillion by 2035. If borrowing costs remain elevated, and the so-called One Big Beautiful Bill adds another projected $4 trillion to federal debt during the next decade, the trajectory worsens rather than improves. Stay with me because this is the point where your 401k enters the story directly. As of late 2025, there are roughly $10 trillion sitting inside 401k accounts according to the Investment Company Institute. Of that amount, about $5.8 trillion is held inside mutual funds. The largest category within those funds is stock funds at approximately $3.4 trillion. The second largest category, often described as stable and conservative, is hybrid funds, basically another term for target date funds. Roughly $1.6 trillion sits inside vehicles specifically designed to shift your money automatically away from stocks and toward bonds as you age. Maybe you never read the prospectus. The algorithm already did it for you, and here's the reversal. Almost nobody inside mainstream retirement media wants to say openly. Most people assume the bond allocation inside a 401k is the safe component, but rising interest rates are actually one of the most dangerous things that can happen to a bond-heavy portfolio. Let me walk through the arithmetic, because once you see it, the math is surprisingly straightforward. When America's credit rating falls, bond investors demand higher yields, higher rates, in exchange for lending money. Higher yields make newly issued bonds more attractive than existing bonds already paying lower rates. That forces older bond prices downward. This is not a theory, it is basic mathematics. Bond prices and bond yields always move opposite one another. When the 10-year Treasury yield rises from 2.5% to 4.5%, exactly what happened between 2021 and mid-2025, a bond fund with an average 7-year duration loses roughly 14% of its value solely because of the interest rate move. Not because corporations collapsed, not because stock markets crashed, purely because the bond market adjusted correctly to higher government borrowing costs. Now let us return to Gary because this is where the theory becomes tangible. Gary is 66 years old with $450,000 invested in a target 2020 fund carrying approximately 45% bond exposure. That equals around $202,500 allocated toward bonds. The average duration on that bond portion is probably somewhere between 5 and 7 years. A 1% increase in Treasury yields generally creates about a 5 to 7% decline in bond values. That means Gary's bond allocation alone could lose somewhere between $10,100 and $14,175 without the stock market moving at all. But stocks move too, and here's the mechanism behind it. Rising government borrowing costs increase what finance professionals call the risk-free rate. Once the risk-free rate rises, every other asset across the financial system must offer stronger returns to remain competitive. That compresses valuation multiples. The same earnings that justified a 22 times price-to-earnings ratio with a 3% Treasury yield might support only a 17 times multiple once Treasury yields reach 5%, before recessions even begin and before profits decline. Simply through mechanical repricing tied to higher rates, Gary's 55% stock allocation could fall another 10 to 15% from valuation compression alone. On a $450,000 portfolio, the combined hit could realistically land somewhere between $45,000 and $65,000 in a single year at age 66, with no ability to simply wait another 25 years for recovery. By the way, if you are finding value in this discussion and have not subscribed yet, hit subscribe now. Otherwise, YouTube's algorithm may never recommend these videos to you again. I specifically focus on the kinds of topics that rarely appear inside mainstream financial coverage. Here's where the situation becomes much more interesting, because Gary's case is actually the moderate outcome. The more serious scenario involves something the retail investing world barely discusses: forced institutional selling. When a sovereign nation receives a downgrade from credit agencies, the change is not just symbolic. It activates clauses buried inside thousands of institutional mandates. Pension systems, insurance companies, sovereign wealth funds, and bond ETFs operate under rules requiring certain percentages of holdings to remain inside specific credit tiers. Once the sovereign rating drops even slightly, some institutions are obligated to sell. Not because they want to, not because analysts believe it is wise, because the contracts literally require it. Now consider the scale involved here. The exact same week, Moody's downgraded the United States government. It also downgraded long-term ratings for JP Morgan Chase, Bank of America, and Wells Fargo. Why? Because those banks hold enormous amounts of U.S. government debt, and if treasuries become slightly riskier, institutions built around them receive lower classifications too. We are talking about the 3 biggest banks in America being downgraded alongside the federal government itself. That is not a footnote. That represents a systemic repricing spreading slowly through every institution exposed to U.S. debt, which includes a large portion of the bond funds likely sitting inside your retirement account right now. Honestly, this next part almost becomes dark comedy, and I want to admit that openly. Fiscal policy is funny only in the sense that it is usually not funny at all. But sometimes laughing is healthier than staring silently at a wall all afternoon. America is currently borrowing money to cover interest payments on money it already borrowed. Then the additional borrowing raises the cost of borrowing even further, meaning more borrowing becomes necessary just to pay higher interest expenses. Then credit ratings decline because debt levels keep climbing, which pushes borrowing costs higher again. It is basically like someone taking a cash advance from one credit card to pay minimum balances on another card, then watching interest rates climb because their credit score deteriorated, increasing minimum payments again. We have all known somebody like that. Understanding these figures and creating an actual retirement withdrawal strategy around them are completely different tasks. I spend an unreasonable amount of time reading financial statements, treasury reports, congressional budget office projections, publicly available data almost nobody else reads. What I rarely see is a framework translating all this fiscal information into a concrete retirement exit date for a real individual. Not vague advice like, save more. An actual date based on mathematics calibrated around your balance sheet and risk exposure. I spent nearly a full year building something I call the Exit Code. It is a digital book containing 8 chapters without filler material, built using 50 years of real retirement data. Two sections directly connect to what I just described. First is the dynamic withdrawal method, a replacement for the traditional 4% rule designed to account for sequence of returns risk during rising rate environments. The 4% rule was built during a 4-decade period where interest rates generally declined, and it struggles precisely in the kind of scenario Gary faces, where both stocks and bonds decline together. The dynamic withdrawal method adjusts spending rates according to where markets currently stand in the cycle, helping avoid locking in losses during the worst moments. The second concept is something I call the 58% rule, based on evidence showing around 58% of American workers experience forced early retirement before their planned date due to layoffs, caregiving responsibilities, or health events. If you are forced to begin withdrawals from your 401k at 62 instead of 67, the standard 4% assumption breaks mathematically. A different number becomes necessary, one built around a buffer calculation. The exit code covers that framework. You can find it through the link below for less than the cost of dinner. Every month spent ignoring your withdrawal math is another month where compound arithmetic quietly works against your plan rather than supporting it. Now let us return to the main discussion because there is another person in this story we have not fully introduced yet. Her name is Melissa. Melissa is 37 years old, works in Nashville as a project manager, and has around $68,000 sitting inside a 401k invested entirely in a Target 2050 fund. Roughly 90% stocks and 10% bonds. When the Moody's downgrade happened during May 2025, Melissa barely noticed it. Her portfolio was still positive for the quarter. The news cycle moved on within 2 days. Melissa is not facing immediate danger. Her timeline remains long. Contributions continue flowing into the account. Compounding still works in her favor. But here is what Melissa does not realize about her future. The glide path formula built into her target date fund was designed during a 40-year period of falling interest rates. Assumptions about bonds, safety, and conservative allocations inside the traditional 60-35-5 stock-bond cash structure were all calibrated for a world where treasury bonds rallied during crises. A world where investors fleeing towards safety reliably pushed bond prices upward during recessions. Melissa's 55-year-old self may eventually inherit a bond-heavy portfolio built on assumptions weaker than they were when the product originally launched. She probably will not realize it until she opens a statement years later. Now, let me clearly explain the counterargument, because this channel avoids one-sided analysis. After S&P Global downgraded America during 2011, the S&P 500 dropped about 17% peak to trough within several weeks. Then something very strange happened. Treasury yields fell. The price of the downgraded asset actually increased. Investors panicked by falling stocks rushed directly into U.S. Treasuries, seeking safety from the exact asset supposedly becoming riskier. The 10-year Treasury traded near 2.5% on downgrade day, then dropped beneath 2% within roughly 3 months. That bizarre outcome became the template afterward. Don't worry about U.S. downgrades because investors still buy Treasuries anyway. The Fitch Ratings downgrade during 2023 reinforced that argument with relatively little market impact and largely stable bond pricing. Many respected analysts, including teams at Janus Henderson, correctly point out that these downgrades have historically produced limited effects on diversified long-term portfolios. Those are legitimate facts, and if you are 32 years old with another 3 decades before retirement, the honest answer is this probably does not derail your future if you stay invested and keep contributing. But here is the variable changing everything. During 2011, the 10-year Treasury yield sat around 2.5%. There was enormous room for yields to decline further. During 2025, the 10-year Treasury already hovered around 4.5%, while the 30-year Treasury exceeded 5%. There is much less room remaining for another massive rally. More importantly, America's fiscal trajectory during 2025 differs structurally from 2011 in ways specifically affecting bond investors. National debt climbed from roughly $15 trillion during 2011 toward nearly $39 trillion by early 2026. Debt to GDP ratios rose from around 65% to nearly 100%. Annual deficits currently equal 6.4% of GDP and are projected near 9% by 2035. The flight to safety trade protecting bond investors during 2011 depended on global confidence that treasuries represented the safest place on Earth during periods of fear. That confidence still exists, but it faces more structural pressure today than at any point since World War II. And if that confidence weakens even slightly at the margins, not collapses, just weakens, the bond rally normally cushioning stock declines becomes much smaller. The people most exposed to that shrinking cushion are exactly the people holding the largest bond allocations, investors within roughly 10 years of retirement. I want to carefully explain who actually faces danger here because this is not a universal problem affecting everyone equally. There are three major groups inside the American 401k system, and the downgrade story affects each group differently. Group 1 is people under 45 who remain mostly invested in stocks. Bond exposure stays relatively small. The downgrade impacts you primarily through slow burn channels, slightly higher mortgage rates, somewhat lower stock valuations, and marginally higher borrowing costs overall. The effect is real but manageable considering your long timeline. Continue contributing. Stop obsessing over Moody's headlines. You are not the primary audience for this particular fire. Group 2 is investors between 55 and 65 inside the glide path transition zone. This is the critical group. This is where direct mechanical exposure exists. Your target date fund probably holds somewhere between 30% and 60% bonds already. That allocation is automatic. It is embedded directly into the fund mandate. The algorithm decides if your bond funds carry average durations between 6 and 7 years and treasury yields rise another 1%, which is absolutely plausible given current fiscal conditions, your bond allocation loses roughly 6 to 7%. A $200,000 bond position could decline by $12,000 to $14,000 without a single stock market headline appearing on nightly television. Group 3 is already retired investors actively taking withdrawals. For this group, the danger is not purely mechanical, it is sequential. If a portfolio declines during the first year or two of retirement, while withdrawals remain necessary, retirees become forced sellers of depressed assets simply to cover living expenses. This is how retirement portfolios fail mathematically. The crash itself is not what destroys the portfolio. The deadly combination is a crash plus simultaneous withdrawals. Locking in losses compounding can no longer repair. Now, let us revisit Gary one final time, because his story actually ends with a solution. After speaking with a fee-only advisor, specifically fee-only rather than commission-based, because that distinction matters, Gary makes two highly targeted changes. He does not panic. He does not liquidate everything. He does not start hoarding gold bars inside his garage. Instead, he shortens bond duration. He shifts away from long-term treasury funds, which carry extreme sensitivity to rate increases, towards short-term treasuries and short-duration investment-grade corporate bonds. Those assets still decline when rates rise, but far less severely. A 2-year duration fund loses roughly 2% per 1% increase in rates compared with 7 to 10% for long-duration funds. Then Gary creates a 2-year cash reserve. 2 years' worth of expected living expenses placed inside high-yield savings accounts or short-term CD ladders outside the portfolio entirely. This is possibly the most boring strategy imaginable. It is also extremely effective because if markets decline 20% during year 1 of retirement, and Gary does not need to sell a single share of stock, because the cash buffer covers expenses, then Gary can wait for recovery without locking in permanent losses. The cash reserve sacrifices some returns during strong years, but it protects the plan during bad years. Now, you might be wondering what any of this specifically has to do with the credit downgrade itself. Here is the final connection. The downgrade acts as the smoke alarm. But what it reveals, the fiscal trajectory of the U.S. government, rising interest rate pressure, and the repricing of duration risk across bond markets, that is the fire. And the fire changes the exact mathematics behind 3 assumptions most people considered settled already. First, how much your bond allocation is actually worth during a rising rate world. Second, what your true withdrawal rate should be once sequence of returns risk gets considered. Third, whether the flight to safety trade protecting retirees during 2011 will function the same way in coming years. The lazy interpretation of this story says credit downgrades are just noise. Markets already proved it 3 different times. Nothing catastrophic happened. Move along. The more accurate interpretation is that every downgrade acts as another data point, confirming a trend unfolding slowly inside yield spreads and fund allocation formulas over years rather than days. The people who got hurt were not the ones panicking during headlines. They were the ones ignoring the long-term trend until the trend finally appeared on quarterly statements at age 63 or 65 at exactly the wrong moment. Lazy investing created more wealth than crypto hype ever did. And if there is one point I want you leaving with today, it is this. The most expensive retirement mistake is not making a terrible trade. It is spending an entire decade misunderstanding what the word safe actually means during a rising rate environment combined with deteriorating sovereign credit quality. 3 things you should specifically do after watching this video. Not generic advice. Specific actions. First, check the average duration of bond funds inside your 401k or IRA today. Most fund providers publish this directly on fund fact sheets. If retirement is less than 10 years away and your bond duration exceeds 5 years, that is a very real and very fixable risk. Most 401k plans already include short duration alternatives. Second, stress test your withdrawal strategy using a scenario where your portfolio declines 15 to 20% during year 1 of retirement. If that leaves you with less than 20 years of spending runway, then you likely need either a larger cash reserve, a lower starting withdrawal rate, or possibly both. The math itself will show which answer applies. Third, stop viewing the stock bond mix inside a target date fund as some final finished product. It is a default setting, a reasonable default, but still a default. The glide path formula was built using historical periods that never included a world where all 3 major rating agencies downgraded the United States, while federal debt sat at 100% of GDP. You are allowed to thoughtfully override the default if your situation specifically calls for it. The smoke alarm is sounding. You do not need to sprint outside immediately, but you probably should know where the exits are.